All right, hey guys. So I'm IHW. My name's Tyler. I've been a member of the group for a good amount of time now, and I noticed in the group a lot of people were interested in kind of long positions. And when I say a true long position, it's like how Nick has been with Tesla, how his cost basis on Tesla is like $120 or $200 or something like that, and he had leaps, and he's been in the position with Tesla for well over a year. This ideally, actually, this conversation is more for potentially 3+ 5+ year holds, and it really comes down to your whole risk factor and the different things that you're interested in as an investor. And I think that being in a trading group is very helpful, but there's only so much when it comes to traditional investing that a stock chart can particularly tell you, because when you're truly investing in a commodity or an asset class, right? You aren't going to particularly care what the price is, just asterisk, but as they always say, time in the market over timing the market, right? So we were discussing just kind of different stocks that I was discussing with Mom and Nick. I actually don't know Mom's real name, so I'm calling him Mom. We were discussing stocks on growth and value, and I proposed it'd probably be a good idea to take a look at just the basic level of the financial statements. And so I want to lay this out kind of as a quick how to find these financials. We're going to be looking at the 10K report over a 10Q. The 10Q report is a quarterly report. The 10K is the annual report that a company files. And I'll go into why we're only going to look at a 10K when we're looking at a long-term investment factor. And then we're going to look at the three key components of financial statements, some risk factors, and then maybe I'll throw in a couple ratios in there for you guys to take a look at in your own free time when you're looking at potential long-term investments. And so when I say this is potential long-term, I'm saying well over a year. If you're buying a leap on the product, you're buying a year or two out leap. That's kind of the idea of within these investments. And so kind of my credentials to go forward. I hold a graduate degree in accounting. I have my undergraduate degree in accounting and music, and so I'm a musician at heart, but an accountant by career. And my background is I've done internships within the non-for-profit and government sector. I did a stint in public accounting for roughly 2 years, serving middle market, over-the-counter clients, particularly in the Columbus markets. I've helped prepare 10K reports. So I have actual exposure with working with management within the thoughts of this. And I currently work for FRG Group, franchise group. I work for one of their subsidiaries handling their entire company leasing department. Well, not their entire department, but actually handling the leases themselves and accounting for them. So I'm currently studying for the CPA exam. I'm still a young professional. I'm only 25. But that's kind of my credentials and my background to show that I do have a history in this. I am versed in this. I do hold a graduate degree in this factor. So it's not just some random kid telling you, hey, buy this. So like I said, the whole premise of this is really to find something where you think markets are going to be at 3 to 5 years from now. And as you've been, seeing, like Tendy says, like ugly stocks, value-based stocks getting getting very sexy as markets get to really to particular highs as the Feds keep pumping the market. So we're going to get forward here of just how to find these financials. I was thinking we could look at Johnson & Johnson first because it's a really basic value-based company, low price earnings ratio around 20. I think they're around like 38 right now. They're going to be here forever. I mean, that's kind of the idea of a value stock. And so what we do when we're looking at financials and how to find these, you don't have to go to Google. You're going to get trapped in some company trying to sell you a way that all they do is they make a fancy script to pull this data up and show it to you in a pretty way. You don't need to do that because all this stuff is public information. As a publicly traded company, everything that these companies pretty much do is scrutinized. And so we're going to begin with how to find these. So I'm actually gonna just restart and say we're at Google here. But the easiest way to find these is by going to the Securities and Exchange Commission website, so sec.gov. And all you have to do is you're going to get this picture here. They're investor advocates, yada, yada, yada. They're a civil regulatory agency. Right here, we click this little button here. It's company filings. And then you can look up a person, you can look up a ticker, anything of that matter. So we're gonna begin with Johnson & Johnson JNJ. So as you see, when you type it in, it should fill here. You just go with the proper ticker. It's going to come up with different search results here. And this is where this is the Edgar company search result. Edgar is the United States regulatory database for all these filings that have to be filed by publicly traded companies. Now, we're going to be looking at the annual report over anything else. And the reason why I bring this up is because when we're looking at 2-3 year long holds, we particularly don't want to care about quarterly statements because one, they're not subject to financial audits. Quarterly statements are not inherently fraudulent by any matter, but they can become subject to earnings management. And what that is that companies can really try and push different accruals in their accounting system to make particular earnings look a certain way for a particular quarterly situation. So there's a lot of different ways that they can kind of finagle earnings in a particular quarter to look better than what is actually going on as the whole. And through the 10K report, they are audited by an independent auditor. When we're looking at large cap companies like this, they're going to be audited by one of the big four accounting firms: KPMG, Deloitte, Ernst Young, PricewaterhouseCoopers, and audit fees and audits are taken very seriously. I think the net average fee for a large S&P company, I'd have to Google it, so don't quote me verbatim on this, but it's probably in the gear range of like $30 to $50 million. It's taken very seriously with how much the costs are. The purpose of an audit is not to give you guys assurance in a particularly specific way in realms of absolute assurance that things are going right, but they want to give you reasonable assurance. And so when I say reasonable assurance, is the auditors come in and look at things as a whole and say, yeah, what the company is saying, from our opinion, what they say they're doing is going correctly. So there's always a risk at reading these financial statements. So now let's take a look into Johnson & Johnson financial statements. A value-based company, as you guys know, they're not a volatile stock. A lot of value-based companies are not volatile. We can argue that Apple is not volatile anymore. I mean, its IV rank is like 30 now. So these are companies that value-based companies, they have lower price earnings ratios. They're going to be here forever, and they are your best friend when the market is bad, and they're just kind of there when the market is good. So we're going to take a look at kind of the key factors within Johnson & Johnson's financials and just broad value-based companies on things that you kind of want to look at and have an eye for when you're looking at your long-term and potential long-term investments. And when I'm saying long, I'm saying well over a year and a half, 2, 3. You're putting this in your personal IRA, your 401k, you're meeting with your financial advisor, you're picking this particular company over just an ETF for whatever reason that you particularly like. And if I'm going too quickly, or if anyone has a question, please just interrupt me. I'm not a instructor by any means, but I have a passion for this stuff, and I like to teach people. So we're going to start with opening up the financial statements. It's the most. Yes, Steve.
Just slow down a little bit.
That's fine.
Yeah,
sorry.
No, that's okay.
I don't want to take an hour. I want to be quick, but I'll slow down. So now that's kind of the going into finding the financials here. So if anyone is clicking along when we go into the SEC government website, we're going to take a look at the 10K annual report filings. And so there's the quarterly reports here, but what we particularly care about is the 10K annual report. And when you load it into here, you're going to get a whole slew. As you can see, this is a long report here. This is I want to say, a 110-page report that's filed on an annual basis for Johnson & Johnson. So before going into kind of the key things that, and I would say my personal opinion, we're just going to look at the basic overview of key things within financial statements, line items that you potentially may want to care about. So as we start off here on the first page, it's going to be just, who the company is, their filing, and outstanding shares of common stock, but it takes us into the appendix here. And obviously there is a ton of information. So I really want to get this into a basic level, starting with the key things that you are able to go to within the financials that I think are material for your understanding at a basic level is the business. If you take a look at general, it gives you what the, who the company, it gives who the company is. It can give you how long that they've been incorporated, and it gives you their segment of business, what they primarily focus on, their particular products. And it's like this across all different financial statements to see particularly, how are they generating money? How are they running as a business? And what are they doing? And so if we go back up to the appendix here, there is other different, as I mentioned, items here that are important. Risk factors we'll take a look at a little bit later, but we're going to go into the meat and potatoes head on, and that's the selected financial statements. They're always, all this stuff is going to be, it's in a particular fashion, so financial statements are easy to read. So you are going to see that it's going to all be within this order in different financial statements. It's going to say qualitative disclosures about XYZ, management's discussions, XYZ. All this follows a format on purpose. So financial statements as a potential investor are easy for you guys to quickly look through and make financial decisions on. So the next part of the financial statements here that I want to get into the meat and potatoes is financial statements and supplementary data. It's the numbers. We're big numbers guys as being traders, and this is what the company is compromised by. And there's multiple different ones, but the ones that are particularly going to be important for us and within what we're looking at is the balance sheet, the income statement, and the statement of cash flows. And what these three are is the balance sheet are long-term assets that the company owns. So if we're going here to take a look at Johnson & Johnson balance sheet here, they're going to give you 2 years of data within the financial statement 10K filing. And there's the assets such as cash, marketable securities, accounts receivable, which is that's money owed by other companies to them. Some of them are pretty self-explanatory. Property, plant, and equipment. Think of that as like buildings that they own, and then they have their liabilities. What liabilities are is what they owe. They have loans. They have short-term liabilities. They have taxes that they need to pay. I want to see if I can remove all these. There we go. They have taxes that they need to pay, and there's different notes that go into more detail, and we can take a quick look at those further. And then there's the shareholders equity, and that's what shareholders equity is the shareholders of the company, the value that's derived after all things are said and done. After they issue common stock, maybe they're purchasing stock back, and it comes down to the level of retained earnings here. So what retained earnings is like I said, it's once all the dust settles at the end of the year, how much value is the company retaining at the end after they've paid literally everybody, after they've paid their taxes, after they've taken losses on whatever, what value is left in the company that is there and is owned. So going into a value stock like Johnson & Johnson here, things that you're going to see that's very common is that they're going to have a lot of cash on hand pretty much all the time. And these are this is in the data of millions. So this is, I believe, that'd be $13 billion or 1.3. I don't have my zeros particularly correct, but that's the sheer size. So things that you're going to see, as I mentioned, is you're going to see a lot of cash on hand. You're going to see high accounts receivable, and you're going to see particularly company value stocks like this aren't going to be incredibly leveraged. They're not going to have a ton of outstanding debt, and they're not going to have a ton of outstanding loans, outstanding short-term liabilities that they need to pay. This obviously isn't a broad stroke for all value stocks, but stocks like this particularly, you might see a trend like this. And so the key components here is what you want to see within a value stock when you're looking at the balance sheet is if everything was going to go south tomorrow and people were just going to stop buying things 50% of the time, and we go to an extended bear market, their balance sheet is incredibly strong. And the way you can see that is they have wonderful they have a wonderful asset sizing. They have good liabilities sizing, and we can go into ratios later on what determines that. And they ultimately have positive retained earnings, and their shareholders equity is positive. So the company is, as a value stock, is gaining value, driving value. So the next part, and please slow me down, please ask a question if you guys would like, if anyone has any questions on the balance sheets, before I move on to the statement of income. Does anyone have any particular questions or something that would like me to discuss a particular line item for balance sheet here? Okay, then I will go forward into the statement of income. The statement of income, do they have it? They might have it. Sometimes they do have these different things broken out here. Okay, statement of earnings, income statement. It's all the same thing. So what the income statement is it's their sales, it's their gross profit, it's their net earnings, it's their provision for taxes. This is arguably kind of, for a value stock, the least important item on the financial statement sheet, because as you can see here, the sales for a value stock like Johnson & Johnson, if you take a look at potentially a value stock like, I'm trying to think of another one off the top of my head, like Berkshire Hathaway, you're going to see very consistent sales lines here. You're not going to see ridiculous growth increases of sales. You're not going to see, as we might, and this is an assumption, take a look at Tesla, they might have 30, 40, 50% growth ranges. You want to see in value stocks here, you want to see solid sales base margins here. You want to see that they're growing, they're 1/4%, 1%. The cost to sell is very leveled out in the realms of what they're selling. If they're selling more items, it's obviously going to cost them to sell with that. And so you're going to see that they typically have very high earnings per share, and that's really with the realms of the balance sheet, the income statement for a value stock, is you want to see just strong, consistent value. Now, it's weird to say growth with that because we're going to compare to a growth company, but like I said, when we're taking a look at value stocks here, we want to see within the income statement just very solid, consistent numbers to know that in your investment, 5 years from now, you may only have a growth, or you may only have an ROI of 3 to 5%, but your investment's not going to be ping-ponging around 50% within the span of a trading year. So we're going to move on to, in what I argue, the most important part. Depending on the company, the statement of cash flows, it's to see what the company is actually doing with their money, and that's going to be the next part here. So as if we scroll back up, there's we just took a look at the balance sheet, consolidated statement of earnings, income statement. It's all the same thing. And then there's the statement of cash flows, and this is what the company is doing. There's a lot of data here. This is what the company is particularly doing with their money. Operating activities, investing activities, and financing activities. And so what operating activities is it's kind of like it's more like the short-term level of how cash is being moved within the company. They say they're purchasing inventories. They are having an increase of accounts payable. They could be writing off assets. They could be having stock-based compensations. That's the realm of operating activities. The next is investment activities. That's going to be when, like, say, they're purchasing large buildings. They're upgrading their buildings. They're purchasing their own stock back. They could potentially be investing in another company. They could be using they could be investing in, say they wanted to buy shares of, I don't know, some small up and coming stock on the IWM. They want to do an aggressive, not aggressive, but they want to do a takeover. Those is where the different things that come in here, and then sales of those subsequent investments. And then after that is their net financing activities, and what financing activities are within their cash flows here is going to be their repayment of debt. It's going to be repayment of long-term debt, and that's more kind of the realms of what they're doing within the realms of financing. And it's coming, and then at the end it's their cash and cash equivalents. So that's the net cash that they have on hand, and this fun fact here it ties to cash on the balance sheet here. And so in a value stock, within the statement of cash flows here, the things that we want to look for is what are they particularly doing within their investing activities, which we'll have to take a look at different notes here in order to get into more detail of that. At least I argue that's what's most important, because they're always going to have a lot of cash on hand being a value stock. They're not going to have large ping-ponging of cash. They're not going to be needing private equity groups to potentially take a large investment in them to have more liquid opportunities within their short-term operating. So it's seeing how much are they, we want to look for consistently they're investing in the company. They're growing, they're purchasing more buildings, and this negative number here means they're using cash. And so they're purchasing, they're as you can see, Johnson & Johnson here in the past 3 years is heavily investing. That might tell us that J&J is looking to potentially increase their value by having outside investments to have different potentially revenue streams onto their comprehensive statement of income. And we want to see particularly as well how, could they be selling investments, and how much are they doing it in relation to their purchasing of investments? Companies are always going to be selling investments off, but it's good to see that, in my personal mind, Johnson & Johnson is aggressively investing over selling their investments. So that could also be potentially a good sign from the eyes of Johnson & Johnson. And is there any questions that anyone has of these three components of the financial statements? I know this is a very fast, very broad overview. I don't want to take people's too much time. I think we can move next into potentially risk factors or management's decisions. Is there any questions that anyone has? Maybe something that within this line that you would like me to discuss, potentially for a value stock like Johnson & Johnson? And if I'm going too fast, forgive me. Okay, if there's no questions, then quick broad overview then of back to the top here, item 8, financial statement and supplementary data. Like I said, balance sheet, income statement, statement of cash flows. And so, permanent assets that, well, not permanent, but assets, long-term assets on their balance sheets, what they're doing within their sales, and then cash flows is what they're actually doing with their money. And then the next thing that I want to discuss, and what we can take a look at a comparison after we bring up Tesla's financial statements, is I could potentially bring these up side by side just so we can see like a visual component of comparison. But the next thing that I would like to show you as a potential investor is knowing the aforementioned risk of purchasing stock in the company. And these risk factors are what the company and management deems important to disclose to you before you purchase common stock of this company. And so when I scroll back up to the appendix here, there's risk factors involved within the company. And you're going to see typically with a value stock, honestly, the risk factors, there aren't going to be a lot of them. They've been around for almost 200 years. They drive value. They consistently are strong within the United States market. Unless hell were to really break loose, Johnson & Johnson is too big to fail. So we can take a look at risk factors here and see this is what you need to know as an investor when you're looking at 3 to 5 years from now, what could cause your investment in Johnson & Johnson in the long term to drop. And so here are their risk factors, and I'm not going to read everyone out to you, but this is important for you to at least be aware of this section. But for example, the top line here is that the company, so they deem these, I don't know, to be honest with you, if these are laid out in level of importance based off, like, say this is the most important risk factor. I'm going to assume so. I didn't get this far within the financial statement preparation. When I was at the firm that I was working at, I was more working within, like the balance sheet, income statement, doing work within getting the data to tie to that. So risk factors are, say, the company business operates in a highly competitive products market, and competitive pressures could adversely affect the company's earnings. So they're telling you that Johnson & Johnson is selling items with very tight margins, makes it very difficult in the long term for them to continue to be as valuable as they are. Some other items is that there's counterfeit versions of products out there, not to bash on the Chinese markets, but as you guys know, there's always the cheap Chinese side of what they're selling, even if they manufacture their products in China, or there could be people in any other country that is looking to sell products at a cheaper level to cheat them out that 5 cents. That could be dangerous. And they could have risk to legal proceedings, that they've had significant fines and reputational damages for Johnson & Johnson. What I thought was actually interesting here was their talcum powder was, they're a defendant in numerous lawsuits for their talcum powder and manufacturing and marketing of opioids. I thought that was kind of interesting for Johnson & Johnson to see that, but I guess that would make sense, being they sell pharmaceuticals as well. And then changes of tax law, that's always material to companies. Tax is always changing. Administration is always changing. And then there's the company, the company has their IP. It might be hard for them to hold on to it. And they'll say right now that emerging markets are risky. And that's particularly all that is very notable. And there's always cybersecurity risk as well. As you can see here, when we take a dive into Tesla's financial statements, this risk disclosure here, it might seem like I'm showing you a lot, is in the grand scheme of things not a lot. And that's what you want to see in value stocks as well. If we particularly continue and you take a look at different financial statements, you don't want to see a ton of risks in a quote unquote value stock, right? You want to be able to know that if you invest in this in 10 years from now, it's not going to be up or down 50%, right? So the last thing that I think is important to take a look at is management's discussion on financial statements. After you've taken a look at it, they actually discuss their thoughts on what's going on within the financial conditions of their financial disclosures. And so this can get really into the details of what is going on. So I'm not going to get too far into this, but they could say that they're investing more in research and development. They're acquiring companies. They are having a better dividend over time, and they discuss these key factors. And it's important for you to see these. So as you see, they're having consistent sales, 0.6% growth year over year, at least in the past 2 years here. And you can see their different sales segment and everything of that. So that's kind of the very, very basic of a value stock, and kind of just the key things within what you're looking at within financial statements. Before I move on to Tesla, the sexy hot girl on the block, the growth stock with a 600 price earnings ratio, is there any questions that anyone has just generally on financial statements? I know I'm going very fast. Is there anyone that we could take a look at, or maybe a general question that someone may have? And I'm doing my best to go as slow as I can. It's hard to gauge my speed.
Go faster.
Go faster? I can if you like, but but no. Before we move on, is there any questions that anyone particularly thought of, or something that anyone would like for me to just do a quick glance at on the financials here? If not, I can move over to Tesla, and then maybe we can put the different financials side by side and then just do a quick glance to see kind of, you'll see really quick the glaring differences in a sexy growth stock versus the value stock that saves you when the world ends. Okay, so let's move on over to Tesla then, and all I'm going to do here is go back to sec.gov. Oh, .gov. We're going to click on company filings here, and we're going to pull up Tesla. Now that I got through kind of just like the meat and potatoes of what is on oh, that's goofy. Let me do the click here. There we go. What is, the very, very elementary things that we want to look at on financial statements. We're going to come into Tesla here, and I think it'd be best actually to just probably put them side by side now. I think it'd be kind of redundant to slowly go through Tesla financials, just because we just went through just kind of key things to look for. So I think what's best here is now kind of seeing the difference of what you're going to see on a balance sheet versus Tesla with a very speculative growth stock versus Johnson & Johnson, the stock that's been on the block for almost 200 years. So we're going to go here to the selective filings, and we're going to pull up the 10K report. And here's Tesla Inc., Nick's baby. And we're going to take a look at some key items within their financials here. So let me move these annoying tags if I can again. I don't like how they do all that highlighting. So I'm going to scroll on down, and you're going to see here, everything's laid out in the exact same way as I mentioned earlier. It's going to go business, it's going to go risk factors, it's going to go management's discussion on what's going on in the company and other particular notable information. So I think what we can do is just generally off the bat go to the financial statements and see some key differences here, and see if anyone would like to give a shot to some things that they noticed within the financials. So let me go to the balance sheet for Tesla. Did I click the right? Selected financial data. They might have it financial and supplementary data. So we're going to take a look here at the balance sheet for both of them. The quantitative. Okay. So here we have them up side by side. Let me see if I can zoom in on Tesla's just a little bit more so they're the same size. Does it not like me doing that? Okay. So, oh, but then it did it for both. Let me see. Let me pull this up on Edge real quick so I can have two different zooms because it. Okay. So we're going to take a look here at now Tesla's balance sheet, and here's what we're going to see that is particularly, just at first glance, I kind of want to ask to the group, what are some things, key difference noticing wise? Let's put our thinking caps on here. On just the balance sheet alone, we take on the right is Johnson & Johnson, and on the left is Tesla. What is something that particularly on the asset side here that someone notices? And if nobody says anything, I'm going to be that teacher and call someone in the group. It's probably going to be Kane, if he's still in here.
Johnson & Johnson's total assets is like 3 times Tesla's.
There you go. That's a very great assumption, and that's a very key assumption there. That's something that's good to see. Anything else that anyone notices?
Who do you think I am, and why? Factor number 2.
So some things that I like to particularly point out as well, in terms of percentages, there is obviously fluctuation. But if you take a look at Johnson & Johnson, as I said, they're pretty much always going to be strong cash on hand. As you can see here, Johnson & Johnson, even if it's 2019 and 2020, you can see they're having, and if this is millions, I'm sorry, I got my zeros messed up. It's either 17 billion, probably 1.7, but
17 billion 305 million.
Thank you. So as you can see here in 2019 and 2020, they easily have over 10, 12 billion dollars cash on hand. And I'm willing to bet that if we look at prior financial statements, we're going to see that they're in the realm of the larger 10 Bs pretty consistently. And as you can see for Tesla, and the financial statements within a year, you're going to see with these speculative growth stocks ping-ponging with almost all of their line items. It's just like kind of like their stock value is, as you can see here in 2019, Tesla had $6 billion on hand, and now they have almost $20 billion on hand. And this is a key. Now, they always say cash is king. It's very basic. You want to be able to see in a speculative growth stock like Tesla in a year that they're able to accumulate that much more cash. Other different things that you can notice here within the inventories, as you can see here, inventories for Johnson & Johnson, 9 billion and some odd million, and that's going to be very consistent. As you're going to see with a speculative stock like Tesla, in terms of inventories, almost $1 billion change is pretty rapidly large. That could be in the realm of inventories. It could be their cars. It could be their it wouldn't be their solar panels because they have the solar energy systems, but just different inventories that they have on hand. You're going to see here that they're going to have a big change within their PP&E. Tesla is aggressively expanding their gigafactories, and those are things that you're going to want to see. When you're looking at a growth stock like this and you're looking at their balance sheets, you're going to want to see growth on their balance sheet to somehow justify their price earnings ratio. And there's ways to get into a quantitative analysis on that. But just in the realms of, you're going to want to see that they're growing exponentially to match their stock price. So that means you're also going to want to see their you're also going to see that their total current liabilities are also aforementally going to grow, since their assets are going to grow by almost a completely 20 billion 20 billion. So you're gonna want to see that they're obviously they're having growth on both sides of the matter. It can be kind of alarming if their assets are up majorly but their liabilities are down a bunch. How is management getting to show that? But the one thing that I want to point out here, and you're going to see across the board disclaimer asterisk, is that retained earnings, stockholders equity, is you're going to see that they have an accumulated deficit. And as you can see here, that the shareholders in the stockholders equity, they're not going to have an accumulative shareholder. They're not going to have an accumulative deficit. If you're seeing a cumulative deficit on a company like Johnson & Johnson, that's very, very scary for a quote unquote value stock. So as you can see, what this means is that in 2019, the shareholders for Tesla, with what the business is doing, has not actually derived value yet. So it's like you're going to see with a lot of growth stocks, a lot of hype happens when a stock is finally profitable. You're going to see that what they're going to aim is to slowly chip away this accumulative deficit. So as a very long-term investment for like Nick, is that he wants to see that their accumulative deficit is aggressively going down to justify the volatility stock price up to where he hopes for it to be, or the investors hope for it to be. The day that I don't want to say when/if it happens, if we see, it's going to be a lot of news when Tesla goes into a true stockholder equity and they're having value being coming in through the company. Negative accumulated deficit isn't end of the world, but that's something that you're going to see within a value to growth stock here. So we're going to move on to the statement of income, which is for them, do they call it operations? Yep. Okay. So then we're going to go to Johnson & Johnson here, and we're going to take a look at statement of earnings. Here, as I mentioned earlier, in a nice value stock, look at the 3 years of sales data and now compare it to Tesla's. 81 billion, 82 billion, 82 billion. Tesla, 17 billion, 19 billion, 26 billion. in speculative growth stocks, this is where things like this and growth stocks are what you're actually going to kind of potentially want to pay attention more to in the short term, because you need to know that in the past 3 years, they are somehow justifying their exponential growth in their stock price, right? Because price earnings as a whole means that if Tesla today, you were to purchase a share of $1, like you put $1 share for Tesla in price earnings, it theoretically takes you, I think it's in line of years, 600 years to get your true quote unquote return on value. So you need to see exponential growth, not exponential, large growth like this. Another key thing that you're going to see is, let's take a look at gross profit here. Their gross profits, as you can see, it's going to be, like I said, relatively the same. You want to see very consistent in value stocks. As I said, like beating the dead horse with Tesla, you want to see their gross profit margins are getting better, and they're getting better fast. And when we're saying fast in realms of companies, 3 years is actually a very short amount of time when you're looking at the longevity of an investment that you might be in for 10 years. So the next part here is, like I mentioned earlier, is that if you see Johnson & Johnson net earnings having a loss on operations, it's going to be very scary. But as I mentioned earlier, it's very exciting for a growth investor like Nick to see that Tesla is finally producing income on their operations. And you see they went from losing $388 million in 2018 to $1.9 billion in income in 2020. So like I said, I'm just going over and over the fact of these are the key differentials that you're going to see within a growth and a value stock when you're looking to have your investments. The next thing that I think is very important as well is, as you can see here, look at the earnings per share difference between Tesla and between Johnson & Johnson. As you can see here, their earnings per share it's fluctuated up, but these are large fluctuations in their earnings per share. And as you can see for Johnson & Johnson, it's very steady. If it's up or down, it doesn't mean a whole lot. The company is still driving a lot of earnings per share for the investor. And then the next and the most important part of the financials, as we mentioned, in my opinion, the statement of cash flows. That's where we're also going to see a lot of gleaming differences in value to growth stocks. So let me go back up to the appendix here and hop to the statement of cash flows. Statement of cash flows. Once again, it's kind of that repeated idea of when you take a look at these, as you can see, net earnings for Johnson & Johnson, boom, 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 consistent. Their depreciation's consistent. They are consistently looking to increase inventories. So sometimes they might be aggressively granting inventories. Maybe they think that they're going to sell a lot more in the next year, something like that. But for Tesla here, things that you really want to pay attention to is their operating activities. And why that matters, because we want to know in the short term what a growth company is doing with their cash right now. We want to know because hitting these quarterly numbers for Tesla is and if they're able to push out these these cars, things of that matter, is very particularly important in the realms of the stock price. And so as we can see here, when we're taking a look at gleaming comparison, is one thing that actually is interesting to me is stock-based compensation for Tesla. I think that's funny is how large it is this year. But as we're seeing here, they're having a reduction in their accounts receivable. Their accounts receivable is going down. They're getting money. They're having large net cash provided by operating activities, and they're getting a lot of cash in their operating activities very quickly within the realms of year to year. So when you're a speculative growth investor, when you're seeing only this much of a $300 million move in a year, that can get kind of, I don't want to say concerning, but it might be time to pump the brakes on just all-inning your port on that stock in the realms of the long term. The next thing that we're going to want to see here is really just that's the important thing to take a look at is the operating activities. If we take a look at kind of financing activities here, you're going to most likely see a lot of issuances of common stock. They're looking to continue to gain cash from that matter. You want to see that Tesla is aggressively paying down their debt, because I do know that they have a lot of corporate bonds outstanding. The growth stocks are always looking to get a better bond coupon rate from Standard & Poor's. They don't want to be a junk bond. They want to be they want to get market share of value investors, because at the end of the day, while Tesla is, looking to have their exponential growth, at the end of the day, Tesla wants to be that key EV. They want to be the key solar. They want to be the key AI leading whatever. So at the end of the day, like, they need to get to that point, but also pay off their debt, because they're going to aggressively take on debt to continue to have this very aggressive growth. So that's always a good factor to see, is that they're very aggressively having repayments of their debt. Here, sorry, I highlighted the proceeds of their convertibles. So what this is that they're repaying their debt. Proceeds here is when they're giving, so when they're, say, their corporate bonds or whatever that they're issuing to like the whales of Wall Street and all of that matter. And the biggest thing is, like I said, we want to see fast, large growth in their cash, because if Tesla is going to go up 200% in a year, things better be growing nearly as quickly in order to justify that investment. And then this is where we're going to take a look at in comparison. Well, I know I went very quick here, and I know I said quick a million times. Is there any questions that anyone has, maybe potentially in comparison of a value to a growth stock of their financial statements? I know this is a very basic and quick overview.
Yeah, I mean, it seems like Johnson & Johnson's financial statement is shits on Tesla.
Exactly, but that's that's not right. And there's that, and that's how it should be, right? Like a company that's been around for 200 years, a value-based stock. If we take a look at, like I said, PE, Tesla, their PE rating. Let's just go on Tesla Yahoo Finance. When we're taking a look at their say, for example, their price earnings ratio, you can see 681, and then we take a look at Johnson & Johnson, 28, based off a trailing 12 months. So you want to that's what's going to be, as you can see here, in a year, and a value stock, and even a year, we need to look at 5 years of data. And obviously we're in bull markets here, but in 5 years, 115 to 163, and then we take a look at Tesla in 5 years.
Yeah, we know the story. Yeah.
Right. But so you want to say a value stock, you're always going to see asterisk, always, them kind of shitting on a growth stock's financials. And that's what these different key things that you like, the takeaway in these long-term investments, when people say have a, based on your risk factor, how much of your portfolio is in growth versus how much of it is in value, is I'll tell you right now is that it's hard to tell because Tesla has been on the capital markets for 10 years, but if we take a look at Johnson & Johnson's, if we take a look at their max now, this is since 1985, they've obviously been through financial crashes. So let's see if we can get to COVID.
That's one of the big things that that shows on the differences when you look at the financials. Johnson & Johnson's, if you look at it from a period when it's taken a hit to a normal period, doesn't move very much, where a growth stock like Tesla can go from its high to a new low that it's never seen before, so to speak.
Mm-hmm. Yep, and that's the importance of these value stocks, and why I always say it's your best friend. These quote unquote attendees, the favorite term, ugly stocks, and how these value based stocks, as things are getting to higher and higher highs, is like when we take a look at the COVID crash, they went from 151 to 123, and you think, well, that could be a very significant loss potentially on a value stock. But the thing is actually this this is the prime time to load up on value, is when things are getting ugly, because you can see in the span of 2 years from they're recovering from their lows pretty consistently. Obviously, there's an anomaly in the data here, and they're always they're having consistent dividends, and that's what's key important in looking at this. And what's, I love that point that Steve brings up, is the survivability within bear markets. I can tell you now, and we'll take a look at a couple ratios just to end, like quick ones so you guys can see it. Is I can tell you now that Tesla and their financials are incredibly leveraged. And so when I bring up an ETF that tracks, I talk about TQQQ a lot, and I'm not trying to get off topic real quick here, but the realm of leveraged companies during a crash. So even just being leveraged on the market itself, I want to show you, this was TQQQ is an ETF that 3x leverages the Qs. And so this is what happened during the COVID crash. It was trading at 52 and it hit $17 a share. Now, I'm not trying to like spread fear, uncertainty, and doubt, but if we go into substantial bear markets, it's not impossible to expect a similar price move from Tesla. Now, am I saying they're going to go to $400 a share, $200 a share? No, but we could very well see, I mean, as you can see in the investment of all-time highs from Tesla, in the span of 6 months of data, Tesla has went from 661 to 883, and this is after the split. I believe their pre-split adjusted share at 883 is what, like $1,300 a share, if that's correct. And you can see, and you can see here in the realm of all-time highs, you could potentially be hitting Tesla at $560 some a share within the span of a couple months without real bear. I mean, I know we had kind of a tech bear market move there after, tech was going crazy, and well, actually, I think that was prior to it when Apple and stuff was on fire. But like with Johnson and Johnson, even if you buy at the highest highs and you dollar cost average, I mean, you're going to see yourself. Obviously, you don't ever want to buy the top, but that's timing the market. You can see yourself at least coming back to a return on your investment, at least break even within a year if you were to buy at the top and never buy again. And those are things that's important to see in value stocks, right? So the one thing that I wanted to go into was key risk factors. And this is where I think is very important to look at risk factors of growth stocks in the long term and how much risk there actually is to being in a company like this. And I'm not saying this to spread fear, but just risk in general. Risk isn't a bad thing. It's just fact of the matter of what's going on with the company. So if I come up to the appendix here and go to key risk factors, if you can remember, Johnson & Johnson was probably 3 or 4 pages tops. If I go to, let's see, risk factors for Tesla, and we go and take a look at risk factors for Johnson & Johnson. Let me go up to I always just like going to the appendix and taking a quick hop. As you can see, COVID is, everyone's going to be, I'm surprised they didn't. So let's see here. So we may experience delays in launching and ramping of production of products and features, or we may be able to control our manufacturing costs. Here, that's a top key line, is they may not be able to control the costs in the long term, and that Tesla could substantially take loss in value if they're unable to justify their rampant growth in the next couple of years to have the trailing move within their stock price, say 5-10 years, 5-10 years from now. They may be unable to grow their global sales, delivery, installation capabilities, servicing charging networks, or may be unable to accurately project or effectively manage our growth. This is the realm of the level of risk, right? So say China just decides to up and flip and just not go their EV craze that they're doing, you can expect that Tesla is going to go into rampant bear market, just in the realms of their stock price and EV stocks in general. Their future growth is very dependent on the demand for EV and the automotive industry. As you can see now going here, so it doesn't seem like I'm picking on Tesla, going into Johnson & Johnson, you're going to see that they could have, theirs is going to be it seems almost kind of more basic in the realms of a value stock. So you can see they could have delays in manufacturing could affect their reputation. The company relies on third-party manufacturers. The company operates in a competitive market because they're very, very close. Soap. That 2 cents difference on they sell 1 million soaps is that's a huge difference in the realms of things. Their suppliers may be unable to deliver their particular components. I don't know if they have a particular, if Johnson & Johnson feels that that's an actual global risk right now. Let's see here. As you can see, it keeps going. So let's go into risk of their operations. They may experience issues with the Li-ion cells within their gigafactory. They may face international operational issues. They are under obligations for their gigafactory for New York. If they're unable to hire very good talent, their company could be harmed. They need top talent to continue to do what the amazing things that they're doing at Tesla. Any unauthorized control or manipulation of their products could have loss in confidence. Say, Lord forbid, a bunch of people hack their self-driving capabilities, and then people are driving their cars into each other. I mean, Lord forbid, right? They might have them unionizing could be a very significant risk. Let's go on to the next couple pages. Additional funds may not be available when we want them, so that's why they're very capital intensive. That's why you want to see that their cash is growing almost exponentially. They may hold digital assets, and this is where I know Nick's not speaking, but I do agree that they just need to get off the whole Tesla Bitcoin hand-in-hand thing that's going on. But they hold very volatile assets, so they could have impairment losses. They're exposed since they're so they're so capital intensive in the global markets. Exchange rates from the dollar to the Chinese currency, dollar to the euro, is very important to them. They might have to be defending themselves on infringement. Let's keep moving on. So as you can see, I think we're on like this. I think we started on like page 11 for Tesla's risk factors, and we're almost at the end to the risk of Johnson & Johnson. See, this is where the realms of, as you can see, 13, and we started for Johnson & Johnson, I think roughly on like page 7, and then now we're, I think it's probably roughly page 7, 8, or 9 for Tesla. We're on page 24, and the risk keeps going. This isn't to spread FUD on Tesla. This is just the fact of the matter that these are key things as a future investor or potential investor that you need to understand what you're purchasing in if you're truly long Tesla, if you're truly wanting to be with Tesla for the next 5, 10, 15 years. If you want to have Tesla in your IRA now and when you're 60, even if you might rebalance and not be as aggressively buying into it, right? Here's some other, we're moving on to the other key risk factors. Let's see here. If Elon Musk were to sell his shares of common stock, such sales would cause our stock price to decline. I mean, Elon Musk, as much as we love him as the meme lord as he is actually a risk to the company because of, if anyone remembers the COVID days, he tweeted one day, stock price too low, IMO, and it took a 5% tank within like 30 minutes, if anyone remembers that. He is a key risk to the company because he is a wild man, and they're straight up saying that Elon Musk is a risk for how much he does own of the company. So this is that's important, is to see that within these growth stocks, there's going to be a lot of risk involved in what you're purchasing in the realms of the long term. And then I think that's primarily the key things of, at first, what you're looking at for a company that's key within growth. And I think if I can take a look at management's discussion on operations, one that I thought was pretty interesting for Tesla was, I was taking a look at these earlier, that I thought was pretty, let me see if I can find it. It was pretty interesting. Okay, right here, I thought was pretty interesting for Tesla is they're doing and I don't know if Nick is able to voice chat or not. I know he's recording. If you might have some more insight on it, but I thought it was very interesting that vehicle sales to leasing partners with a resale value guarantee and a buyback option. And so what they're doing is when they lease vehicles at the end of the lease term, they settle their liability of the lease within the liability in cash or by purchasing the vehicle. And they might, the leasing partner may recognize the sale of the vehicle. And then what they'll do is they'll take the remaining balances and they'll actually, they see that reselling Tesla vehicles might actually generate more value as if it's like a rising asset almost, which is interesting to me because vehicles depreciate. So I was wondering, and if you can't voice chat, but I wonder if there was I thought this was something that was kind of interesting, and if anyone does have any thoughts on this matter. If not, that's okay. I just thought it was something to take a look at key management discussion. Does anyone have any thoughts on this if they are more versed in this?
You may see something like this in other automotive companies that handle their own financing programs, because basically what they're doing is they're bringing the vehicles back. So they're paying off the liability to, in other automotive companies, the liability is really to the dealership or the loan in the dealership, but they're bringing them back, they're refurbishing the vehicles, and they're putting them out. So it's actually a potential second income stream for the same vehicle. I think that's what this is a little bit about, but I
know that I thought it was interesting because and it goes into more details within realms of that. And
the other thing is, sorry, the other thing is you were talking about some of the liabilities that are, or risks rather. First of all, the reason that you expect Tesla to grow so much more is because of the risk. That's the idea of investing in a risky asset. The second one is one of the risks that you went through today actually is coming to fruition for all of the EV companies right now. And that's the fact that Biden, during his speech this afternoon, pointed out that they didn't make an accommodation for any kind of discounts for buying EV automotive type vehicles. Rebates, whatever was left out of the bill today. At this point, they still haven't gotten it in, which will cut into sales potentially if people were buying it expecting to get a credit. If that doesn't get written back in.
That's very interesting actually. I didn't know that's what they actually, because I know when Biden was elected, I know EV green stocks and everything in general just went wild. I know like ICLN went crazy for an ETF, and that's actually wow. That's wow. So that's huge news. I'm surprised to hear that.
It's I don't know if it was supposed to be in the bill they signed today, but he was pointing out that these are things that they still don't have that the Democrats wanted. And I happened to just, it was in background noise and I happened to hear them talk about the EV credits. And I'm like, wow, that's, and that may even explain some of the downward turn of the EVs this afternoon.
Mm-hmm. And that's awesome to know. And then like what I wanted to take just a very quick look at just as a wrap up is two ratios that you guys can look at. And I don't have these memorized because I'm not a dork, but I do know the premise of them. And that's the acid test ratio and the current ratio. And yep, that's fine. Nick, we're actually almost done. Probably a couple more minutes tops. Yep, I understand. I just wanted to bring this up real quick just to show you guys the different ratio, and we could do I could just pull up the calculator and just show you guys really fast. So, the current ratio is the company's, and just to read this just word for word, ability to pay off short-term liabilities. That you want to see a company that has a strong current ratio, and so I wanted to show you just kind of the sizing difference between Tesla and then Johnson & Johnson, just so you can see just kind of the sizing difference between the two. So let me go back to the financial statements. So as we can see for Johnson & Johnson this year, their total current assets is 51 billion, and we divide it by the current liabilities. So that means for every dollar of liability, they have $1.20 currently ready to pay that off. And those are key things. Like those are things you want to see a large number in this in value stocks. And then what you can do is we take a look at Tesla. You can show that they're most. I'm going to guess that they're they're going to be very leveraged with the realms of these riskier stocks. So if we take a look real quick at their financial statement balance sheet, if we take a look at their current assets, well, if they don't want to give their, okay, so 26 billion. As you can see that Johnson & Johnson's was $1.20. They have 25 more cents per dollar of ready to pay off their short-term assets. That's actually, Tesla's current ratio is higher than I expect it to be. So that's actually, that's pretty awesome to see within the realms of things. But as you can see here, when they had 12 billion in total current assets versus 34, I believe that's going to, I'm just curious to see real quick. I'm sorry, that's total assets. I apologize. Current liabilities. Did I mess up my numbers? I'm trying to go real quick here because Nick wants me to wrap things up. $13. Well, I apologize if I did my math incorrectly. Yeah, so that's pretty strong for a company that's pretty leveraged. That's good to see. And then the asset test ratio is inventories aren't like readily liquid. So current assets can fudge kind of their ability to pay off short-term liabilities. See, like $9 billion in inventories. It's going to be hard for Johnson & Johnson to liquidate all that to pay off liability. So asset test is something that's is something that you're going to potentially want to compare when you're looking at different companies. So if we take their current assets minus their inventories and then divide that by their total current liabilities, as you can see now it's down to 98 cents when it was $1.20. And so they have 98 cents per dollar of current liabilities. And now Tesla, if we do the same thing, we take a look at their current year assets, and then we're going to subtract their inventory of 4 billion and then divide that by their total current liabilities. This is actually something that you're going to want to see in a growth stock is as I mentioned earlier, they're aggressively going to be able to grow to pay off their current liabilities. So there are different ways, and now if we got into it, like how much leverage Tesla is and all that kind of, if we got into really complex models, and we would see that, I'm sure Tesla is a lot more leveraged than Johnson & Johnson is, but I got the call to wrap this up. I know I went pretty quickly, but I really do hope that some of this information was valuable to someone that was watching this, and I really appreciate anyone who sat through this completely. If does anyone have any other questions or anything that key feedback, something that they maybe got from this, I'd love to hear it.
Man, I think it was great. It really answered most of my questions.
I'm glad to hear that.
I appreciate it, man.
Of course. I didn't have any slides prepared or anything. I thought about doing it, but I wanted to wrap things. I wanted to try and keep it short and sweet, but financials can get long and boring. But it's important to know what you guys are buying when you're long something, right? So these are key things that you want to take a look at, other than just buying Tesla because it's Tesla, or buying CCIV because it's CCIV, or buying Skills because it's Skills versus like Johnson & Johnson or Berkshire Hathaway. So I really appreciate everyone taking the time to listen to this tonight, as I was very excited to do it, and I've never taught before really, other than given some lessons on accounting homework. So I obviously have a ton of room for improvement, but I really hope you guys at least learned how to find financial statements, just some key things to take a look at. And if you're bored one day, pull up Tesla and pull up another hot growth stock that's on the market right now and compare them. That's where you can start seeing, like, compare Tesla to, I don't know, what would be a good one to compare it to? I'm not going to pull it up, Steve, but what would be a good one to look at from your mind that you think would be like another
Right
good,
now,
like,
right now, technically, they still consider Microsoft a growth stock, although I consider it a value stock, and
I would
AMD is
agree.
still a growth stock.
So we're not going to do that, but in your free time, if you're bored and you're looking to go long on one of these stocks, potentially, 4, 5, 6, 10 years out, take 10 minutes and take a look at their balance sheet size, take a look at the difference, take a look at their price earnings ratio to see kind of where it's going and kind of what they're doing in their statement of cash flows. I didn't go into it, but in the appendix, there's other notes there, and it'll say in the key financials, it'll say debt note 6. You can find it. It'll have a little 6 there, and it'll tell you kind of primarily what they're indebted to, things of that nature. So I thought it was very important just to see the broad overview of what you're going to see on the financials of something that's not particularly risky and something that has a lot more risk to it, and going long on something and understand that. Being able to just take a quick dive into them.